Right, on to updates relating to the impact of the war. Now, what happens when war risks mount on the world? The world turns to borrowing. The global debt mountain, which is already peaking at $353 trillion, could surge further due to ongoing risks in the Gulf. With AI boom already straining corporate finances, wars can further dent the already fragile global debt market. Take a look at this next report for more.
Global debt has climbed to a record high of nearly $353 trillion in the first quarter of 2026. Debt levels rose by $4.4 trillion between January and March, marking the fastest pace of increase since the second quarter of 2025. Now, the surge was led largely by government borrowing in the United States and China, even as corporate debt issuance also accelerated. The IIF says that the global debt-to-GDP ratio remains at 305%, underlining how elevated borrowing levels continue to remain across the world economy. In China, the state-owned enterprises were among the biggest contributors to the borrowing surge, with debt accumulation significantly outpacing sovereign institutions. In the United States, corporate bond markets continue to expand, supported by strong investor demand and AI-related financing activity. The report also highlighted changing trends in global capital flows, with investors gradually diversifying away from U.S. Treasuries, while demand for Japanese and European government bonds strengthened. China, meanwhile, has continued reducing its holdings of U.S. Treasuries, extending a trend that began during the first U.S.-China trade war. The Institute of International Finance says the impact of the Iran war has so far remained contained in debt markets, but warns that intensifying geopolitical tensions could create longer-term financial pressures. The report says governments and companies are increasingly prioritizing supply chain resilience, energy security, and new trade partnerships, all of which carry major fiscal costs. Higher defense spending, aging populations, and rising AI-related capital expenditure are also expected to push debt levels higher in the coming years. The IIF warns that elevated borrowing combined with higher interest rates could increase inflation risk and make debt servicing more expensive globally. Business Bureau Report, WION World is One.